The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Hello, everyone. Welcome to the Bucket Plan webinar. Today, we're going to be covering protect your clients from market volatility. So this has been a series, and we've been, of course, Dave will be here with me. And what we've been doing is covering the different components of the Bucket Plan best interest process. And so one of the key components is the volatility tolerance analysis. And it's really crucial to protecting your clients from market volatility, because ultimately that's why we call it a volatility tolerance analysis, is because, for the most part, we're using a lot of managed money portfolios within our recommendations of stocks and bonds. We're not doing a ton of individual securities. So at the end of the day, the way we look at it is it's more about volatility than it is about risk. And so we really want to precondition the client to understand volatility is the ups and downs of the market. Risk is more associated with us potentially losing that money. Now, as long as we've positioned the money correctly and segmented the money into different buckets, it's really about managing volatility, not managing risk. And so that's why we call it volatility tolerance analysis. And what we're trying to do is position it into the different buckets and what we do, and then ultimately eliminating the client from making bad decisions or being irrational, because they understand there's going to be a certain amount of volatility on certain segments of money. Typically in the first bucket, there's going to be no volatility. In the middle bucket, there may be some or very little volatility. And then the third and final bucket, that's when they're typically willing to take on a lot more volatility to be able to optimize equities out in that later bucket.
Yeah, and Jason, I think one of our most important functions as a financial planner is to counsel our clients on staying the course with the investments that we feel are best suited for their long-term financial goals. And you've and we're going to talk about it a little bit, but you coined one of my favorite terms I use with clients, and it's freak out risk, right? And we've all seen some of the studies. These are great pieces that you can take home and use with your clients. But Dalbar puts out an analysis every single year. This is looking at last year. This is 2018. And what Dalbar shows is, how did the average investor stack up against the S&P 500? And so if you took $100,000 and invested it in the S&P 500 index and just closed your eyes, never looked at how the market did, you'd have a pretty decent return for the year. Over 20-year annualized returns of right around 8%. But if you look at the average investor, they're right at about 4 to 4.5%. And so what Dalbar started to do is they said, well, why does the average investor do so much worse than the index fund itself? And so some of these things, are outside of some of our control or the clients that control. Like, there's fund expenses. I mean, the reality of it is you can't just buy the S&P 500. You have to buy an index fund, and the fund companies charge expenses to do that. There's a need for cash that comes up, right? Maybe the advisor didn't quite plan for enough liquidity in that now bucket. Maybe they have a lack of cash to invest. But look at that big one. That big one is voluntary investor behavior. Over 1.5% of annualized 20-year returns comes from voluntary investor behavior. And I point that back to simple common terms. I mean, I look at that, that's freak out risk, right? These people freaked out and they made bad decisions. And so having a solid foundation from a volatility tolerance analysis can certainly help eliminate that freak out risk. And this is another great piece that we see. Again, this is the S&P 500. But what causes that freak out risk? Well, the stock market is like a roller coaster. So, you go through these cycles. It's almost like the emotional or the investor psychology. I think it's more of an emotional cycle than anything, where if we look from the dot-com bubble and when it burst, people were depressed down at the bottom. Then you start to go into this market recovery and gain hope, and then relief, and then optimism, and then excitement, and then thrill, and then euphoria. And then what happens? Well, markets go in cycles and they correct just like they always do. And we saw that in 2008. Now, in 2008, we saw it at a different level than we've previously seen in history. But you start to create some volatility, some uncertainty, some talks about recession that creates anxiety, denial, fear, desperation, panic, right? And this is where if the clients don't have a solid plan in place, they haven't properly segmented their money, they're looking at all their money as one big bucket, and there wasn't a proper assessment done on the amount of volatility they're comfortable with, they can make some really bad decisions. And
well,
so
that's the key is you have to explain to the client that this is healthy in the later bucket. This is what it's supposed to do. If you're willing to take this ride, you're going to ultimately earn a really good rate of return. You're going to earn more money in the later bucket than you will in the soon. And so, but you have to be willing to take the ride.
Absolutely. And Jason, this is a piece, you actually introduced this to me. This is an overlay you probably haven't seen before, but you introduced to me this Callion piece a number of years ago, and I use it all the time. And basically what it does is it color codes each asset class. And then it ranks them at the top highest performer and at the bottom worst performer. So like in 2018, cash equivalents was the highest performer, while emerging market equity in gold is the lowest performer. And you see these squiggles on here. This is a little bit different version of it. And what the squiggles basically represent is the yellow line is the S&P 500, right? The most prominent benchmark that I think most clients follow in the media on how equities perform. And the white is U.S. fixed income. Again, so I think when a lot of investors think about investing, right, it's like you have stocks in the S&P 500, you have bonds, fixed income. And the reality of it is, if you trace these two asset classes year by year, it's like an EKG machine, right? There's no rhyme or reason. One's up one year, one's down one year, one's back up, one's back down. And so if you don't have a good foundation of volatility assessment, it's going to be really hard to keep your clients comfortable to be, remaining the course. And I think this is a unique visual just to see the choppiness of those returns.
Right.
And I mean, the reality of it is, we all know investing in the market, it's like a roller coaster, right? It has its ups, it has its downs, but I think we're all in agreement right now, especially with computers, technology, and the fact that I think the last stat I saw was like 80% of the volume of the stock market is just driven by computer trading at this point. It's like, it used to be a big deal if the S&P or the Dow fell by 500 or 600 points. And it seems like that's like a somewhat normal occurrence these days. So while it's still a roller coaster, the twists and the turns of that roller coaster are just a lot bigger, steeper, higher hills, bigger drops. And the reality of it is people's ability to take on that ride changes over time. It's funny, my wife and I were joking the other day. Both of us used to love roller coasters. Like back when we were in high school, we used to love roller coasters. And we used to be able to go on pretty much any roller coaster out there. Jason, by your lake house, you have Cedar Point, one of the tallest roller coasters in the world. You used to love that. A couple of days ago, I was on the swing with my 3-year-old and I started getting dizzy because I was swinging too high. And like, that's just an example of how, as people get older, their capacity or appetite for this stuff changes. And so if we can help our 30s. Yeah, exactly. It's pathetic, right? I can't even go on a swing and I'm 35 years old. God, who knows what'll happen when I'm 50. But I think this is such a strong reason that clients need us. They need advisors to help them. And I had an appointment last night with the client, and I shared with him this piece because we were talking about my fees, right? And the portfolio management fees and my advisory fee, my 1% that I charge to be their wealth manager. And I brought this piece up with that client. And I said, and he was actually in Vanguard funds. He was in a couple target date funds. And I said, this is put out by Vanguard, the company that you invest in right now. and they know how important an advisor is. And they actually did a whole bunch of research, and they calculated that an advisor adds about 3% to a client's portfolio over time. And so if you look at how that's broken down, you get, maybe about 0 to 115 basis points on portfolio construction, the fact that somebody's rebalancing and all the value that that brings. You get a 0 to 145 basis points on wealth management. That could be incorporating tax planning and legacy planning, social security optimization. But that far right one, that's the biggest component. And what is that? 150 basis points for what? Behavioral coaching.
It's behavioral coaching is so much about having a plan in place too, and that's the power of the bucket plan. Because and also what I wanted is the portfolio construction piece. That's where that Callan periodic table really plays a big role. Because too many people, if you run a risk and diversification analysis report or an investment audit, we'll call them, basically you can see where there's a lot of there's too much overlap or too high concentration in certain asset classes. Often it's large cap, and especially people are chasing previous returns because large cap done so well. But as we know, diversification is the most important thing because you never know what asset classes are going to have a run for a number of years. And so without that crystal ball that none of us have, that's the importance. So I love that Vanguard piece because it shows the portfolio construction. You can use the Callan periodic to back up that. The behavioral coaching is a big component of the bucket plan, right? And having them stay the course and avoid freakout risk. And then you have the wealth management, which is really what is the definition of holistic planning, right? It's that comprehensive planning where you're looking at all aspects of their life, making sure the tax planning, the social security optimization, is all coordinating with the insurance and the investment.
Absolutely. And I mean, the value of hiring us, right? Look at this is Vanguard's number. So, I'm not saying this will happen every time, but, Jason, if you give me $1 and I give you $3 back, how long would you play that game for? Right. And that's the value that we could bring, right? You pay 1%, but if somebody's bringing this type of value, this is what a true holistic advisor, to your point, can do with the right tools, the right portfolio construction, the right planning process with behavioral coaching, and then bringing additional value added. It's such a big benefit for the consumer out there. And so let's talk about risk a little bit and volatility, because that's what the purpose of today's webinar and training is. Dr. Wade Pfau, from the American College Professor of Retirement Income, I was actually just at dinner with him last night, and he put out a great article that had to do with risk and volatility. And he stated retirees have less capacity for risk as they become more vulnerable to a reduced standard of living when risks manifest. Those entering retirement are crossing the threshold into an entirely foreign way of living. And I think if you asked all of us, we'd be like, yeah, that makes sense. I mean, somebody gets closer to retirement, right? Jason, you call it the money cycle. You built a tool around it. And as people get closer to retirement, they should dial back risk. But what Wade and I were talking about last night is the reality that two things happen to most people out there. As they approach retirement, they become too conservative and they lose potential purchasing power by not having enough of their money in growth assets still. So they almost go over the top. Or the other is they fail to make any of their money conservative. They stay invested like they're a long ways out from retirement, when in reality, it's right around the corner. And those are two big dangers that our clients face as they approach retirement.
Yeah, I mean, the one is inflation risk, right? Because you don't have enough money in growth assets, primarily equities, to outpace inflation. And then the other is sequence of returns risk, where you have too much in growth assets. And that's the whole idea of segmenting the money.
Absolutely. And I mean, he goes on that the risks that those retirees face, and this is good language you can use with your clients, reduced earnings capacity. We know that when they stop working, they get into their late 60s, 70s, they absolutely have reduced earning capacity. Visible spending constraints, heightened investment risk, unknown longevity, spending shocks, compounding inflation, declining cognitive abilities. These are things that all can come out through a risk assessment. I did the volatility tolerance analysis with a client last night. And again, like they kept joking, like, it's going to be really interesting how I score these in 5 years. They're 62 right now. He kept saying, in 5 years, I can't wait to see how I score this. In 10 years, I can't wait to see how I score this, because things change over time. So one other thing that I wanted to talk about here is there's a big difference between risk appetite and risk capacity. And I feel sometimes this is where risk assessments can fall short. And we've identified this and spent a lot of time talking about it, Jason, at the bucket plan training that we do with advisors that come through this. But there's an appetite for risk, but then there's a capacity for risk. And sometimes those two things don't align. And it's important to have that mindset with your consumer. Just because somebody has an appetite to take on more risk doesn't mean they actually have to within their financial plan. And I always use the example. I have a client that he scored that he has an appetite for a higher amount of risk. But when I ran his financial plan, he was going to be able to meet all of his goals and objectives in a more conservative portfolio. And so I sat the options down and I said, hey, I know you have the appetite for more risk, but I also wanted to show you, you actually don't need to take it. You can meet all of your goals and objectives on a more conservative level. Now, the downside is you're going to be invested more conservatively, so it might mean less wealth to your family. But the positive is you don't have to stomach a more wilder ride of the stock market. And so having those discussions around risk appetite versus risk capacity could be really helpful when you are educating clients on what their options are.
You know, Dave, I've been saying this for years to people. When I recognize that all they're going to need to do, either they don't need to draw off liquid investable assets because they have enough fixed income sources, Social Security, pension, etc., or they're needing to draw less than 3%. I typically will have this conversation with them that, listen, you guys have done an amazing job. Like if life is a game, you know, and the American dream is to accumulate enough income or assets that you can live the rest of your life the way you're accustomed to and never have to worry about running out of money, you won the game. You have won the game. So now the question you have to ask yourself is, how much of that win do you want to risk? Because you're already in a position. And then I have the same conversation as you just did. I'm not going to repeat it. Is really just about, is it about leaving more money for the long haul, or is it about having that peace of mind to know that you're never going to run out of money? You never have to worry about income for the rest of your life.
Yeah, that's fantastic. So when we get into, I want you to talk about this a little bit, Jason, because this is something that I feel you've really pioneered. You've helped me implement over the last, 12, 10 years. But, kind of what most advisors do versus what, we believe is a more efficient way to help segment money and then assign potential risk and volatility to it.
Well, the challenge that I had for many years in doing, because I've been doing bucketing for a long, long time now. And the challenge that I had before we really refined the process and built the volatility tolerance analysis is all the risk assessments out there were scoring it as if it was one giant bucket. And so the reality of it is you're not going to invest the money that you're going to be drawing off of or need sooner rather than later and have a very short time horizon and need for liquidity to be able to take heavy income or withdrawals. That money is going to be invested completely different than money that you have a 10, 15-year time horizon before you're going to need to access the money. And that was the flaw in the risk assessments that I was trying to use for years, was they didn't bucket, right? They weren't associated buckets. It was like it was the traditional, systematic withdrawal income planning SWIP methodology of just taking the old 4% rule. And so, typically you'd fill out a risk assessment, and let's say it comes out as a 60-40, and it would look something like that on the screen on the top right. But the problem is ultimately, you go into 60-40 portfolio, look at the max drawdown, 35.5%, right? I mean, that in itself will absolutely cause freakout risk. And so freakout risk is a real thing. That's what causes that 1.5% a less return that an investor could ultimately earn. It's a real thing. So by segmenting the money and then scoring the buckets separately, it really buys them that it cements the concept of bucketing, because they've actually scored it, and they're telling you, you're not telling them, they're telling you how they want to invest the different segments of the money. So each segment has its own time horizon. So this is like kind of step one, is first we want to set the premise for the bucketing. Then we want to overlay, and do the risk assessment on each of the buckets. Now, when I say each of the buckets, we don't do the now bucket, because that's money in cash. It's just the two buckets, the soon and the later. And then ultimately in step three is where we're making sure that we're diversifying across different asset classes, especially in that later bucket. Because usually in the soon bucket, so when we think about diversification, we got to look at all three buckets. So think of cash as the soon bucket, the now bucket. The soon bucket is going to be your fixed income or fixed income alternative. And then the later bucket is going to be much more diversified across all asset classes. And a healthy portfolio is going to look something like this. Overall asset class, small amount in cash, fixed income is going to be whatever amount you need to solidify the income or buy the time horizon in the client. From a behavioral finance standpoint, you want the now and the soon bucket to give them the confidence to stay the course and take on the volatility in the later bucket with the rest of the assets.
Now, Jason, when you're segmenting the money, is time horizon the only thing you account for in determining like how much should go in each bucket?
Yeah, it's time horizon, it's purpose of the money. I mean, those are the two key components that you really want to focus in on: time horizon and purpose of the money. That's what it is. Ultimately, income consideration is going to be factoring in the now and the soon bucket. We never take income out of the later bucket. What happens is the soon bucket feeds the now bucket, and they consume the money out of the now bucket. The later bucket is almost like, if you think of, you ever been to one of those water parks, like where it has the kids areas, and they have that giant bucket up in the sky, right? And it takes minutes sometimes. It takes 5 minutes. It takes whatever, and all the kids are watching and the parents are watching, because you don't want this giant bucket to splash on your head this cold water, right? And you're watching it, and then eventually, though, it gets full, and then that bucket empties. Well, think about that in the later bucket, because it isn't like every year. Every year we're not moving money from the later bucket to the soon bucket. It's when we've just had a really good run on the market and the soon bucket starts getting depleted, because it's the one that is feeding the now bucket for income purposes, then we'll reload the soon bucket. So that soon bucket is, we're buying time horizons, or we're buying bridges of income.
So let's talk about step two. You mentioned, and I know this was just a game changer for me as an advisor, but once you've segmented, then you overlay the risk assessment.
Right, and that is the order, and it's because it's something that, again, getting them to buy in. First, what we need to do is kind of look at their money in segments based on knowing what their income need is, and knowing what kind of the purpose of the money and the time horizon is. But then secondly, then we're doing the risk assessment, right? Then we're overlaying the risk assessment on top of it. And so then we can kind of take a look at it and understand that, oh, okay, this is what it looks like. I'm going to be conservative, because in many cases, clients will want to make changes. They'll want to diversify and even have a little bit more money in the later bucket. Or maybe they'll want to take some of the money in the later bucket and say, you know what, I actually want to shift a little bit more of that into the conservative bucket, into the soon bucket. So they conceptually get that, because now they own it, because they've scored it. So first we segment the money, then we overlay the risk assessment, and then 3, we're making sure that we're very diversified in our offerings within the bucket.
Yeah, and what I love about it is, I mean, from an advisor, this concept, right? It's completely product or portfolio agnostic. I mean, we threw some basic look at cash, fixed income, equities. Like, it doesn't become more generic than that. But you can bring a lot of sophistication to the strategies, the solutions that you decide to deploy in the soon and later bucket. But the clients get it, they understand it. It's such a powerful communication tool. So let's do this. I want people to be able to see the VTA, the volatility tolerance in action. And so we've got Casey on the line with us also. And Jason, let's role play going through the volatility tolerance analysis. So Casey and I will be your client. You're the advisor. Walk us through how you would actually take a client through the volatility tolerance analysis.
Perfect. So now keep in mind, what we've already done with them is we've already taken them through a good part of the process at this point, right? And so we're really getting to the point near the end of the process where we're going to make specific product and portfolio recommendations within these buckets. And so, that's kind of where we're at. So we know already what their income gap is. We know, what their time horizon is. We know what the purpose of the money is. So we really have a very good idea what their situation is. And really, ultimately, when you go through our training on the bucket plan, it's a 2-day training. We teach the foundational tools first, and then secondly, then we teach exactly, best practices when it comes to charging the planning fees. And one of the concepts that we teach in the second 2-day training, we have a 1.0 and then a 2.0. Once you master the foundation of the 1.0, then we go on to the 2.0. There's a lot more sophistication and more best practices that industry veterans and top advisors have layered into the bucket plan process. And the reason I'm telling you this, though, is back to what statement I made a little bit ago, is what we found is that when we sketch out the bucket plan with the client, whether it be on a whiteboard or on a notepad, when we sketch out the concept of the three buckets first, then they kind of get that how much money would potentially go in the now, the soon, and the later. Then we're to the point where we are now on the volatility tolerance analysis, where we're going to say, okay, let's do the overlay now of how much risk or volatility are we willing to take on in each one of the buckets. So I'm sitting down with the client, and so I'm going to sit with you, Dave, and Casey, our special guest. Welcome, Casey.
Thank you.
All right, so we're sitting down, and you guys are 3 to 5 years out from retirement, and we're doing a retirement income plan. We're getting towards, we've done the bulk of the heavy lifting at this point, and so now we're scoring your volatility. I'm going to do kind of a friendly reminder of just the concept of the 3 buckets, the now, the soon, the later. And I want to remind you that, the now bucket's not going to be invested. It's money in cash. The soon bucket is the money we're going to draw for income purposes to feed the now bucket, which is where you're going to take your withdrawals, automatic, deposits into your bank account in the now bucket. And then the later bucket is our long-term money that we bought a time horizon. So we're willing to take on more of the ups and downs of the market to be able to earn a better rate of return. Does that make sense?
Yeah, that makes total sense.
Yep, thanks.
Great. So now what we're going to do is we're actually going to score the later bucket first. So let's assume, like we've talked about, that we've set up an ample amount of money in the now bucket. So that's kind of your sleep insurance. Everybody's got a magic number. You have that number and you're in the bank account. Let's assume that's all established. And we've set up enough money in the soon bucket to meet your income needs for the next decade. And so now let's think about the money in the later bucket, knowing that we have at least a 10-year time horizon before we're going to need to access that money. I'm going to ask you a series of questions here to understand how much volatility you're willing to take on, ups and downs in the market in the later bucket. So the first question is, when's the earliest time you would expect to draw from your funds earmarked for your later bucket? Now, remember what we're looking at 3 to 5 years before you start drawing your soon bucket, but then your soon bucket is going to last a good decade. So about how long of a time horizon does that mean we have in that later bucket?
Yeah. So for 3 to 5 out, and then 10, it's that 15 to 20 year range for the later bucket.
Yeah, I would agree. And then secondly, with a 10-year or more time frame, right, 15 years or so that we talked about, what would you expect from your later bucket investments over time? So there's 5 different options. You can read them here. Outpace, generally keep pace with the market, trail it but make modest profit, have a high degree of stability but make small profits, or be little affected by what happens in the market.
Well,
I think for me,
Casey, you follow the market. So what do you think here?
yeah, I think that I'd be most comfortable keeping pace with the market.
Okay, good. So generally keep pace with the market. So and that's good. I'm glad you answered that, because it's important to understand that, outpacing the stock market. So let's say, we're using, a lot of people use S&P 500 as the benchmark of the stock market. To outpace it means we got to outguess it, right? And so to generally keep pace means that we're really primarily in equities and we're keeping pace with what the market is. Because as we all know, if I had a crystal ball, I don't know that I'd be sitting here right now, right? And so I mean, to guess what the market's going to do, that's very tricky. And a lot of people try to do that. But for the most part, if you just keep pace with the market, you're going to do really well over time. So good answer. Number 3, I'm comfortable with investments that may go down in value from time to time if they offer the potential for higher returns. How would you answer that question in looking through these?
I mean, I guess we would agree somewhat on that. At the point where we're at in life, hopefully 3 years out from retirement, worst case maybe 5. I don't know. I'd say we agree somewhat. What do you think, Casey?
Remember, this is later bucket, though, Dave. So Casey and Dave, the only thing I want to remember and agree somewhat, but I'm just, as a friendly reminder, as we're filling this out, kind of keep that context of the later bucket. But that's a great answer. Agree somewhat. On to the next question, number 4. Suppose the stock market is down over the next decade. What would you expect from the investments in your later bucket? To be down,
I think for me,
if
we're keeping pace with the stock market, I would think that I would expect it to be down.
Yep, that's exactly right.
I don't know how else we could try to keep up with it without having to be down if everything else is.
Yeah, you got it. And so that's another great answer, because that's the key is we want volatility. As crazy as it sounds, we want to be down in the later bucket from time to time, because if we're willing to take those ups and downs, that's when we know we're going to do really well over long periods of time in that later bucket. Number 5, 2 weeks before you leave for your dream vacation, you lose your job. What would you do? Extend your vacation, proceed as scheduled, or cancel it?
Well, I think Casey would extend it, but I think we would probably just proceed as scheduled. So I'd say proceed as scheduled. Wouldn't you agree, realistically?
Yeah, if we're being realistic.
Yeah, I mean, chances are it's already paid for anyway. Right?
Yeah, exactly.
It's scheduled, right?
So, hey, what else do we have to do? If we don't have to work, we may as well go somewhere fun.
Right. Considering your later bucket, which of these statements would best describe your attitude about next year's performance of your investment? Who cares? 1 year means nothing. I wouldn't worry about losses in that time frame. Or maybe if you suffer more than 10%, you're concerned, only tolerate short-term losses, or you'd have a hard time stomaching any losses in the later bucket.
I don't know about you, Dave, but I think that when you get to that 10% threshold, that's probably the point where I start to get concerned. What do you think?
Yeah, I'd say concerned. I mean, I don't think, like, again, as Jason mentioned, it's our later bucket. I wouldn't like put the panic alarm on, but nobody likes losing more than 10%. I'd say that's a good answer.
Good, great. And then last question. So and this has a little bit of visual you can see here with it. So really it's just showing kind of the ups and downs over a 1 year period though, again, right? So this is later bucket, but this is a 1 year period. So assuming you had a $100,000 to invest, which of the following potential gain and loss possibilities over a 1 year period would you prefer? And so you can see the numbers here. You have a lot of upside in option one with quite a bit of downside as well. And then you go all the way to the other end of the spectrum of option 5 with very little upside and really very little to no downside. And so in that later bucket, you know, which potential gain and loss scenario would you feel most comfortable with?
I think just looking at this option number 2 looks good for our later bucket. You know, not the highest, but certainly, you know, we can afford to take on the potential for some downside with that higher upside because it's, as you mentioned, it's our later bucket.
Good, great. So now let's tally up the score. 27, and you scored a growth category in the later bucket. And I'll explain to you what that means here in a minute. But very similar to how you just answered that last question. You know, your growth, not the highest level, but second highest at growth. And I'll read to you what exactly that means here in a few minutes. There's 5 quick questions on the soon bucket. So the first one we know the answer to. When do you expect to take your first distribution? Well, that's 3 to 5 years. We've already talked about that, probably earmarking about 3 or 4 years. Second, while asking yourself, what do I most want to accomplish? Select the objective that best fits the purpose of your soon bucket. So what's the purpose of our soon bucket? Now, have you go ahead and read through these.
I don't know about you, Dave, but for me, looking at the soon bucket and the purpose is I want to be a little bit more on the safe side. And like that first one, preserving the value is, for me, my focus. How about you?
Yeah, I agree, especially if this is going to be like, you know, a smaller amount we're going to need to depend on to be able to retire. I think going with preserving value and having some safety there is good.
Good. All right. And then next question, how would you rate your willingness to take on market volatility with accounts you may depend on for potential distributions sooner rather than later? No volatility, low volatility, average, or above average?
I think, you know, probably average volatility here. Right.
Mm-hmm.
Yeah, I think that probably makes sense.
All right. And then number 4 in your soon bucket, for money that you may need to draw from sooner rather than later, how much could your account balance go down in a single year before you feel uncomfortable? So any fall, or then 5, 10, 15, 20, 25%. What amount would make you feel uncomfortable in the soon bucket if it were to go down that amount?
25 is definitely too big for me for the soon bucket. So I think I'd be comfortable with 10% until I start feeling uneasy.
Yeah, that 10% was sticking out to me too.
Okay. All right, great. So next question, final question. In your soon bucket, which mix of investments do you find most appealing for accounts you may depend on? In your case, guys, you will depend on for distribution sooner rather than later. So this is where we're going to be drawing our income from in 3 or 4 years from now, out of the soon bucket to fill up the now bucket. So portfolio 1, you got 0 high volatility, 100% low. And then it keeps dialing up all the way to portfolio 5 of 80% high volatility, 20% low. Think of it as like stocks and bonds. 80% stocks, 20% bonds. It won't necessarily be that, but that's a good way to think of it. Or 0% stocks, 100% bonds, or fixed income, or somewhere in between.
Yeah, I think because preservation and relying on this for income, I'd probably say portfolio number 2.
Yeah.
Great. Good. Let's tally it up. So it looks like we have 11, and the score is stable in the soon bucket. So now let's look at what this means. We scored growth in the later bucket. We scored stable in the soon bucket. So when we look at growth is focused on achieving market-like returns with a primary objective of capital appreciation, so growing the money. The typical portfolio that fits into this category may experience a large amount of volatility. Remember, this is our later bucket. The more volatility, the better return we're typically going to have over a period of time. So does that sound pretty accurate, the growth of the later bucket, of how we'd want the money invested and be comfortable?
Yeah. That sounds accurate to me. Yep.
And then stable is focused on achieving current income with a primary objective of preservation, but willing to accept a small amount of market exposure to help increase potential returns. The typical portfolio that fits into this category may experience a small amount of volatility. So if we go to the next page, so basically in the stable bucket, or in the stable scoring of the soon bucket, it means we're going to probably have some stock or equity exposure, and we are going to have some volatility in it where we're drawing our income. So I know you already said you agree with the results of the later bucket. Do you also agree with the results of the soon bucket of the stable scoring?
For me, Jason, because we're going to be really growth oriented out in the later bucket, if there was a way in our plan, like if we had the ability to not have stock exposure in that kind of soon bucket, I mean, I feel like me personally, I would rather go that route. I know it might be a little bit less potential return, but I think stability and peace of mind is important there for me. What do you think, Casey?
Yeah, I'd agree with that. I definitely think you're onto something.
Okay. So no equity exposure in the soon bucket would be the gist of what we're saying. Okay. Good. And you know what that matches up, guys? Do you remember the question I asked you when we went through and did your income gap assessment to identify how much we're going to need to draw off of your soon bucket? And I asked you the question of how much income do you want guaranteed? And do you remember what the answer was to that question?
Yeah, all of it and then some.
Right. And so this aligns really well, and I'm glad this is reinforcement that we're on the same page and we're on the right track, is that if we want to guarantee all the income, we really can't take on market exposure in the soon bucket, because then that component or a certain percentage of it won't be guaranteed. So this is, our conversations are continuing to match up. It means we're on the same page, and that's good.
Good. All right. So that was a good role play. What was great about that is Jason, you obviously were doing it, educating and showing how to really be inquisitive, ask a lot of questions. It took maybe about 15 minutes, a little under that, to get through that whole exercise. But I'll tell you, and you see it over and over as well, it's just so impactful, some of the responses and the rationale that you get. And the reality of it is there's 13 questions, so 7 later bucket questions and 5 soon bucket questions. But if you really boil it down, there's truly 5 later bucket questions that you don't know the answer to coming in. There's 2 of those questions that you know the answers to from the work that you've already done. And then in the later bucket, when they're going to retire, right? When they're going to start taking income from that soon bucket most of the time. And so if you really kind of boiled the whole thing down, it's 9 quick questions. But the power of it is to make it conversational. One of the biggest mistakes, Jason, that we see people make, and we teach this in our live training, is don't give this to the client as homework to fill out by themselves. You want to do it just like Jason did it with us and make it as interactive as possible, because you're going to get some great insights into how that client is thinking. The other thing that I just wanted to touch on, and you probably saw this, the assessment is built to be very product and portfolio agnostic. There's categories. See, some of the challenge with typical risk assessments is they pigeonhole you into, just using market-driven, like AUM, portfolios. But if you're really kind of offering both a holistic approach of insurance vehicles and investment vehicles, this assessment really doesn't pigeonhole you into one or the other. The language in there is very open. And so, Jason, do you want to just share quickly how you use it on your annual review?
Yeah, so in the annual review, we really just simply reinforce that, hey, has anything changed? This is our score in our later bucket. This is our score in our soon bucket. This is how we're invested in the soon, how we're invested in the later. Are we on track? So we have a step 4 agenda. Basically, it's our annual review process. And so every year we revisit. We don't redo the entire volatility tolerance analysis, but we revisit it to make sure they're still comfortable with the way they're scoring and the way they're invested.
Now, we will redo it if there's basically big life changes and we need to reassess risk, like passing of one of the spouses, a marriage, moving, new jobs, big things like that. It is good to redo it every few years. And so we hope you enjoyed today's webinar, really diving a lot deeper into understanding and assessing risk and volatility. We do have a white paper on this topic with a lot of great things you can use with clients. Protect your clients from market volatility. Highly recommend you download the white paper, read through that, as well as the podcast, the Bucket Plan On Demand podcast, where we're going to dive deeper into talking and sharing stories of implementation with clients so that you can gain some of that perspective. But we appreciate you jumping on the Bucket Plan On Demand webinar, and we hope you found value out of it. Appreciate your time, Jason, for jumping on with me, and Casey for that fantastic role play there, so that all the advisors that are attending this training can hear it from a advisor-client perspective. And I hope everyone found some value in this, and appreciate your time.
Make it a great day.
The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.